Hello and welcome. In this lecture video, I'll talk about the effective interest amortization method. I'll talk about leases, and then we'll review some quick check problems. Okay. So as we were talking about in some earlier lecture videos, we talked about the straight line amortization method. And when we're talking about the amortization method, remember what we're referring to is amortizing that discount on bonds payable and then the premium on bonds payable. And amortize, as we said earlier, is just a fancy word for spread out. Okay, so the way we did it with the straight line is we said, here's the total amount of the discount or the premium, and then we divided it by the number of total payments. And so what that gives is a constant amount of either discount or premium that is either added or subtracted from the cash that we pay our bondholders to derive bond interest expense. That is one method. Another method is the effective interest, okay? And the way the effective interest method works is it multiplies the carrying value of the bond at the beginning of the accounting period times the market rate of interest. So in this case, it's called the effective interest because the rate used to amortize the bond is always the market rate of interest. And so it's the same rate every single time. Versus the straight line method, it's the same dollar amount of amortization every single period. With this one, it uses the same interest rate to calculate the amortization every single period. Okay? And that's what we're saying right over here. It results in the same interest rate being applied, but a different amount of interest expense. The straight line method, it's the opposite. It's the same amount of interest expense, but a different effective rate. Okay, so let's look at this example. Suppose we issue a $100,000 bond at 8% contract rate. When the market rate is 10%, record the first semi-annual interest payment. Okay, so what we could do is we can multiply our 96,454, which is our carrying value. So for our first interest payment, that's what we're looking over here. Our first interest payment, we multiply our 96,454, which is the carrying value of the bond, times the market rate of interest. But remember, this is semi-annual. So this market rate is annual. So what I have to do is divide 10 by 2 to give me 0.05 or 5%. So I'm going to multiply this times 0.05. And when I do the math, I get my 48,864. This is my debit to bond interest expense. So now I will do my journal entry and I debit bond interest expense for 4,864. Okay. And then just like I did with the straight line method, I will credit my discount and then I will credit cash. Well, how much do I credit cash for? Well, remember, that's always par value times contract rate. So 100,000 times 0.04, not times 0.08, it's times 0.04 because it's semi-annual. So that gives me the credit to cash of $4,000. And now what I can do is I can back in to figure out what my discount is, my credit to my discount on bonds payable. Ran out of room there. Discount on bonds payable by taking my bond interest expense subtracted from the cash that I have to pay my bondholders, and that equals my credit to the discount on bonds payable account. Okay? Now, if we look at this table, which is on the next page of your course pack, you can see we had our 4823, and so I actually have to cancel that out. Sorry about that. I was looking at the wrong one. Okay, 823 right there. Sorry about that. So typo. It's a debit to bond interest expense of 4823, credit to the discount, then credit to cash 4,000. I was looking at the next period, which is my 4864. Okay, so now what I have right over here is I have my 96,454 times the 0.05 gives me that 4823. That's the debit to bond interest expense, credit to the discount on bonds payable, and then a credit to cash 4,000. And then what happens to my carrying value? Remember, the carrying value of a discount bond is equal to par plus unamortized discount. And that's the discount bond. But on the premium bond, it's equal to the par minus there, par plus the unamortized premium. The typo. With the discount, it's equal to par minus unamortized discount. With the premium, it's equal to par plus unamortized premium. So if we look over here, we decrease the unamortized discount by $823, which means now the unamortized discount is $2,723. How did we get this number? We take that $100,000 minus our unamortized discount. So the unamortized discount is smaller. That gives us the carrying value. Then what we do the next accounting period is we multiply that 97. We multiply the 97,277 times the 0.05, and then that gives us that 4,864 right over here. This would be our debit to bond interest expense, credit to the discount, credit to cash. Next accounting period, 98,141, which is $864 less for our unamortized discount. 100,000 minus the 1859 gives us the carrying value of the 98,141 times the 0.05, and so on and so forth. This becomes the debit to bond interest expense, credit to the discount, and then credit to cash. Okay? So let's talk quickly about leases. I just want to give a pretty quick overview of leases. Okay? So it's a contractual agreement between the lessor, the asset owner, and then the lessee. Okay? Who is the renter. So if you've ever rented an apartment before, you know what a lease is. Just a rental agreement almost. Okay? So that grants the lessee the right to use that asset for a period of time in exchange for cash or rent. All right? So there's two different types of leases though. There's operating leases, and operating leases are short term. And in that case, the lessor retains the risk and rewards of the ownership. Examples are apartment or renting a car. In that case, the lessee records the lease payments as expenses. The lessor, who owns the asset, right, who retains the risk and then keeps the asset, records those lease payments as revenue. The lessee does not report that on their balance sheet. Okay? Capital leases are longer term leases. Okay? In that case, the lessor is going to transfer basically all risks and rewards of ownership to the lessee. This would be longer term leases of buildings or airplanes. Okay? To be considered a capital lease, has to have four different criteria. Transfers the title to the lessee, contains a bargain purchase option, lease term that's 75% or more of the leased asset's useful life, or the present value of the lease payments is 90% or more of the leased asset's market value. What I want you to know for the test is just the concepts of these two. I'm not going to be testing you on this. As you move into intermediate accounting, if you go on to take intermediate accounting, you'll go into more detail on leases. I just want you to know the difference at a pretty high level between an operating lease and then a capital lease. Okay? So on these next few pages, we have these quick check problems. We have this one right over here. And with 117, I want you to give me the full journal entry. Give me the full journal entry, although I'm not asking for it here, but I want you to do that. And then this one talks about installment notes, and then then you can choose the best answer here and the best answer here. So go ahead and stop the lecture video and complete those quick check problems, and then we will go over those together. Okay, thanks so much. Okay, so hello and welcome back. So with this first one, a company has bonds outstanding with a par value of $100,000. The unamortized premium is $2,700. The company retired these bonds at a call price at $99. This may have confused you, but remember we've gone over this. This says 99% of par value. That means the price is $99,000. So compute the gain or loss, and I actually asked you to do the entire journal entry. So first thing is we have to compute the carrying value, which is going to be the par plus the unamortized premium. Carrying value is $102,700. The call price is $99,000 because it's 99% of par. Okay. Carrying value is greater than price, which means we have a gain. How much is the gain? The carrying value minus the call price, $3,700. What is the full journal entry? Debit bonds payable, debit the outstanding premium on bonds payable, credit to cash for our, I'm going to cross that out, $99,000, typo there, $99,000, which is the price. Sorry about that. Credit to cash for $99,000, and then a gain of the $3,700, which is the difference between the carrying value and then the price. So this is the full journal entry. Debit bonds payable, debit the premium, credit to cash for $99,000, not $100,000, and then a credit to the gain of $3,700. And remember, this gain is going to be considered additional revenue on the income statement. Okay. Let's get number 120 here. We have $30,000, 6%, 3-year note, installment note. Calculate the payments. You take the $30,000 divided by the factor, $11,223 is the payment. Okay. Let's take a look at the next one. January 1st, our company borrowed $100,000, 10-year 7% note payable. Here is your payment. Required journal entry for the first payment. So what we actually have to do is figure out the interest. And remember, we take the outstanding loan balance times the interest. That gives us $7,000. We're given the payment. So we take that payment minus the interest. That's how much goes to the note payable. So it's going to be a debit to interest expense for $7,000, a debit to notes payable for $7,238, and then a credit to cash for that $14,238, which is the total payment. Let's look at the last one, which deals with the effective rate. January 1st, a company issues bonds dated January 1st, the par value of $300,000. The bonds mature in 5 years. The contract rate is 9%. The interest is paid semi-annually. Market rate is 8%. Bonds are sold for $312, $177. The journal entry to record the first interest payment using effective interest method would be what? So we have to first calculate our interest expense, and the way that we do that is we multiply the carrying value. Well, the carrying value for the first payment is going to be equal to what we sold it for. So this is the carrying value, the initial carrying value. And we multiply that times the market rate of interest. Remember, the market rate is 8%, but it's semi-annual, so it's 4%. This gives us the interest expense. Then we need to determine and calculate how much cash we have to pay our bondholders, and that's always equal to par value times contract rate every single time. So par value of $300,000 times our 0.045 gives us that $13,500. That's how much cash we pay our bondholders. We then subtract that from our interest expense, and then that is our premium, our debit to our premium on bonds payable. So our correct answer is A, which is debit to interest expense, $12,487.08. Debit to the bond premium on bonds payable, $13,500 minus our interest expense, and then a credit to cash for $13,500, and that's how much we pay our bondholders. Okay? Hope you got all those right. Please let me know if you have any questions. Thank you so much.